Alright everyone, welcome back to the channel for another Bitcoin update. So in this episode we're going to be talking about Bitcoin lines of attack. Within this episode we're going to be talking about the most prominent lines of attack, mainly being the ones that we've been stuck under since Bitcoin's previous all-time high. Also another line of attack that's been in play for about 110 days. Then we will be quantifying the lines of attack in terms of their degree of attack, looking at the relief rallies after every attack to the downside and subsequently judging, is this relief rally that we're witnessing at this moment in time normal, and what should we expect from a drop of this degree. With that being said, let's jump right into today's episode. Now, I thought about drawing these all out individually and subsequently explaining them one by one, but then I realized it's probably best to look at all the data points as a collective, so we can go through these one by one and compare the data from each drop. So that's exactly what we're going to do. We're going to draw all of these attacks to the downside. We're going to talk about them. We're going to quantify them in terms of their US dollar drops, their percentage drops, their time drops, and their degrees of attack. So this one being a minus 63 degree attack, this one being a minus 56 degree attack, minus 53 degrees, and minus 72 degrees. Now, for the rest of this video, to make it very, very simple, instead of saying minus 63, minus 56, blah, 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 I'm simply just going to say a 63 degree attack. So I'm not saying minus every 10 seconds and elongating this video. So let's look at the first collective of attacks. I'm going to separate these two data points and I will explain how I came to this conclusion to the latter half of this video, but for now let's just explain the two data points. So what we've got with the first two capitulations to the downside is collectively a 63 degree drop and a 56 degree drop. Now, technically speaking, if you are looking at the degree at which the third capitulation dropped to the downside, this was actually a 53 degree drop. So looking at the high end of things, 63 degrees, looking at the low end of things, 53 degrees, and taking the average of that, you have more or less round about this 56 region. It would definitely be slightly higher than this, but nonetheless, just making it an approximate to make it easier for ourselves. This is kind of the average of these two drops, at least in terms of the degrees of attack. Now, when you do come on to the fourth data point, you will notice this was a 72 degree attack to the downside, and subsequently this was magnitudes higher than any previous capitulation that we had had. You could definitely say, hey, this was, a 9 degree increase over from the initial capitulation, which was 63 degrees, which is definitely true. But if you're taking an average of the first three, because these are all very similar, and then looking at something like the standard deviation, seeing how much the fourth capitulation capitulated further than the other ones, it would definitely be a magnitude of around 2 standard deviations, potentially even more, from the mean of our data points. So that being said, let's move on and look at how long these data points have been taking play for. So the first data point took 24 days to play out from its market high up here at the local top down to the local low. And for here, we're also looking at these data points from local highs, local lows, local highs, local lows, local highs, and local lows. So the first degree of attack took 24 days to come into fruition. The next one took slightly longer, 28 days. The next one after that took slightly longer, 44 days. And subsequently, if we're following the trend and we're looking at the averages of these three, with the averages of these three in both the degrees of attack and the time that it took to take, they're all very, very similar, and they all follow a very, very similar pattern. However, we come over to the fourth attack, and you'll notice, not only was this an exponentially larger degree of attack to the downside, but this took place over 18 days, which, even if we go back to the start of this trend, where the data didn't take too long, and then it expanded, and subsequently we should expect that it should expand over here, it didn't. It took quicker than the first capitulation to the downside, and this is part of the reason why the degree of attack was so brutal, once again coming in at a 72 degree attack to the downside. Now, What I will say with this before we do move on is I don't necessarily think this is the bottom, but one thing that you can definitely take away from this is the fact that the trend is exponentially shifting to the downside. We looked at this when we looked at the data points on the info line. I'm not going to do it again, but we simply measured, you know, from here to here to here to here, and the degrees of attack from every local top, local top, local top, local top, local top were all becoming more exponentially brutal to the downside. And this makes sense when we're looking at the last couple of data points, which is why I've separated these two. There's definitely some similarities with the third one tying in with the averages of the first two, but at least from the data points we've looked at so far, the fourth degree of attack was an absolute market outlier. Now, let's look at the US dollar valuation drops, and more importantly, the percentage drops. So why do I say more importantly the percentage drops, like the US dollar denominated drops aren't as much of an importance? Well, it's simply because, like I said, in my opinion, they're really not as important. Now, why is this? Well, you can imagine when you're up here at 69,200 and you're capitulating down to 41,600, you're going to wipe out a lot of the US dollar valuation without necessarily wiping out a large amount of it, of the market cap and the price in terms of percentage terms. So while this was the most brutal run to the downside, 27,500, and then you're topped out with, you know, 19,000 and 22,000, which once again, looking at this, what do we notice? 27,500, this is the high end of the US dollar valuation drops to the downside. 22,900, this is the average, and I probably should have said this second, but 19,000 is the low end. So you've got the low end right here, you've got the high end of things right here, and this third data point is once again helping the average of the first three data points kind of solidify, and you know, they all kind of tie in with each other. Whether you're looking at the how long they took to drop to the downside, you know, the trend continues with all of these. Whether you're looking at the degree of attack to the downside, the third one seems to support the average of these three. And once again, you know, when you're looking at the US dollar drop, these three are very, very similar. And when we look at the percentage drops, which once again is far more important, because, you know, you can wipe out 27,500, you know, when you're at very, very high valuations, but when you're at these lower valuations, you know, you'll definitely wipe out less, but the degrees of magnitude in terms of the percent drops will be a lot higher. So with our first drop, we have about a 40% capitulation to the downside. With our second drop, you've got almost a 37% drop to the downside. And then this is why I've separated these two data points. You come onto the third data point and you've got a 47.5% capitulation to the downside. And then looking at the fourth data point, you've got a 46% drop to the downside. So once again, US dollar valuation on the fourth one is also a massive outlier from these three. I'm really not too interested in the US dollar valuation. As you can see, the degree of magnitude in which this capitulation took place was much more exponential. And in terms of where we are in the market structure, a 46% drop over 18 days was definitely the most brutal that we've had so far. You know, you might be looking at this and saying, hey, this was a 47.4% drop. This is 1.4 percentile points more of an increase to this one. This one also dropped, you know, 23,000. This one only dropped 15,000. But the degree of magnitude in which this degree of attack took place to the downside was once again much more exponential. So what I noticed with these data points is the first two are very, very similar, and you can definitely argue that, you know, I'd honestly say there's probably more reasons to argue why the third data point still does tie in with these two, even though the US, the percentage decrease definitely ties in more with the fourth data point. But just to make it plain and simple, you can see this is really why I think we should separate these two data points. These two scenarios were very, very similar, and these two were very, very different. And this is why I want to focus when we're looking at the relief rally on this. You know, what was the relief rally on these other capitulations, which were almost equally brutal in magnitude? Definitely a deviation also off from brutalness in terms of capitulations, but nonetheless, both of these two capitulations have been very, very brutal. Now, we've looked at the degrees of attack, we've quantified the moves from the local tops down to the local bottoms. Let's now look at the relief rallies that were subsequently yielded after the local bottom was in. Now, drawing from here up to this local top, drawing from local low up to this local top. And once again, bear in mind, you know, this local top up here could change at any moment. By the time I've uploaded this, we could either be down at 20,000 and then this will be solidifying as the local top, or we could blast up to, you know, 25, 30,000, whatever it is, and this could be invalidated. But nonetheless, I'm going off what it is at this moment in time. Looking at the first two data points, you've got a 25% drop and a 46% drop. Now, considering these two were fairly standard drops, not wiping out a huge amount. Bear in mind as well, you know, this was a 36% drop, this was a 30 or a 40% drop. Once again, these US dollar valuations were pretty brutal. Nonetheless, even the US dollar valuation of the second one was nothing on what we've got here. And to reiterate, the percentage drops are far more important, especially as we're looking at percentage rebounds to the upside. So I want you to focus on the percentage drops and percentage rebounds. So we've got about a 40% drop, 25% yield back to the upside. Over here, you've got a 36% drop, and this was a 46% run to the upside. So, you know, right off the back, if I was to make a hypothesis without looking at this, I'd probably say, you know, the more you drop in terms of percentages, the higher you're likely to rebound. But at least based on our first two data points, that's proven to not be the case, because the bounce rather that we had from this bottom was much weaker than the bounce that we had from this 36% drop. But nonetheless, we moving on to the third and fourth data points. You will see over here a 47.5% drop, and subsequently we had a 27.5% rebound to the upside. Now, with this drop as well, this drop so far has been less brutal in terms of its percentage drops, and so far we haven't actually rebounded as strongly. So once again, there is a very strong similarity between looking at our first two data points over here and looking at our second two data points over here. It's very evident that these two are the more, you know, sunshine and rainbowy, everything's good, you know, nothing's happening too crazy. And then, you know, this is kind of where shit gets real, you know, shit kicks into exhaust. We're having massive capitulations, you know, 47% capitulations, 46% capitulations that are happening, you know, within, you know, 18 days in this one, 44 days in this one, which once again was the longest data point. But nonetheless, this was the most brutal drop in terms of percentages. This was the most brutal drop in terms of degrees of attack. And then these two, there's not too much brutal about them. This one was, you know, the largest US dollar valuation drop. Once again, this was coming into play when Bitcoin was at 69,000. So it's not surprising to see that, you know, when you're up at these massively higher levels, you're obviously going to have a higher drop than when you're at lower levels. You know, for example, when Solana's at $250, for it to have a 50% capitulation, it drops, you know, $125. But when it's down at, you know, $50, it only needs a 50% drop and it drops $25. And subsequently, you know, the percent drop is as brutal, but the US dollar drop just doesn't really make sense when you're looking at it, because with every drop, the market cap, the price of it goes exponentially to the downside, and subsequently the next leg down, even if it's, you know, a worse drop in terms of percentages, you can imagine it won't keep up in terms of US dollar valuations. But nonetheless, what we have learned about this is these two data points are almost playing out to the teeth. I've talked about this previously on my channel, how these two fractals are absolutely beautiful. They're almost working out to the teeth. The only difference with these is that you formed a bearish pennant here, you broke up to the upside and emmed out to the downside, and over here you formed a bearish pennant, you broke to the upside, and this can definitely be an M, especially if we start heading down very soon. But we actually poked our head above this previous wick, which in traditional M patterns, you know, it's preferred that an M pattern looks like this rather than an M pattern looking like this. But they are both completely valid. This one just shows that the market is weaker, and this one just shows that on the second bounce, you know, strength tried to come in the market. But if you do once again come back down to that neckline, which would be round about here, you know, it's just going to basically say, hey, that was an over an exuberant jump, and now we're heading down to the downside. So I think it seems fairly obvious looking at the data points, once again clearing these up because the last two are what I want to focus on, because, you know, it's all good looking at what happened like half a year or so ago or a year ago, but we want to know what is going to be coming into fruition at this moment in time. Now, it's very, very evident looking at the drops in terms of not US dollars, but looking at them in terms of percentage drops, looking at them in terms of their degrees of attack. These degrees of attack, these attack lines have been absolutely brutal, and at least a couple of standard deviations more brutal on average than our first two data points. What this tells me about the market structure over on Bitcoin is when you're in these final capitulations, you're getting very, very close to the bottom. There's only so many times Bitcoin can have a 47% drop followed by a 46% drop, followed by maybe we'll have another, let's see, because I think we're going down to about, you know, let's just say 15,000, because I think between 16.5 and 14,000. So let's just say, you know, the average drop that I expect it to come down for is about another 27 or 28%. We could definitely see one final absolutely brutal capitulation to the downside, and this could take place after our FOMC meeting, this could take place after our GDP meeting, and if we were to follow the same degree of magnitude of absolute brutalness as we did before, I'm just gonna, you know, slightly increase this one. Let's say we lollygag, because we have in the next, what's the date today? The date today is the 18th, and in the next 10 days, we're going to be finding out what is going on with the GDP, what's going on with the FOMC. So round about these dates over here is where we could potentially expect our next leg to the downside. And if we do bounce around and then take that next major leg down, I think that confirmed recession pairing with something like 100 basis point increase in the markets for the interest rates, I think this could definitely take us down for one of our quickest and most brutal capitulations that we have witnessed on Bitcoin. Now, to conclude the video, I would like to finish on one final point about this parabolic curvature line to the downside, and that is that you should take it with a grain of salt for two reasons. Number one, this trend line has been retroactively fit to encompass the data points, meaning I didn't draw, you know, a trend line from here to here and it said, hey, we'll fill in the rest of it for you, and then this is what will happen, and this has perfectly predicted everything. That's not what's happened. Recently, in the past 2 or 3 days, the last time I drew this on my chart, I had to fit this data point retroactively to all of these areas, so it fit absolutely beautifully. So just like how the Pi cycle bottom was retroactively fit using moving averages after the bottom was in play. So a lot of people don't know this. People say, you know, the Bitcoin Pi cycle bottom called every bear market low, but they don't know that it was made 2 years ago, and it was literally just people fiddling around with moving averages until they found that it worked. So once again, take it with a grain of salt. It is retroactively fit to the data, and I myself have retroactively fit it. So there are going to be people out there that do draw it slightly different than me, especially if you go on a trading view. This is a very, very fiddly line, and you will probably get a slightly different result if you are messing with it. Now, number two, and one of the most important things of all, this is a trend line. If you do watch my channel, you'll know I'm not the biggest fan of trend lines. Why is that? Well, if trend lines were all we were using, then, you know, the breakout of the bear market started over here at 19,500, right? We broke above it, back tested it. That was all we need. Confirmed breakout, to the moon we go, and wait. We go all the way back down to the downside, make another low. So while trend lines can be useful at identifying short-term breakouts, because basically, you know, you imagine a trend line, why this makes sense is anything above this white line here is a large area of supply, and, you know, supply comes into the market, supply comes into the market, supply comes into the market. It dilutes the price when they are, you know, dumping the supply on the open market. Once the supply gets exhausted and sellers get exhausted, you finally do flip above it and you have a parabolic run to the upside, or, you know, you have a dead cat bounce to the upside, whatever you want to call it. Just because you break above this trend line does not mean that it's a bull market. We can absolutely do something like this, go to the upside, and then have something like FOMC, they decide, or the Fed rather, on their next FOMC meeting, they decide 100 basis point increase is coming. So price goes to the downside. While the price is going to the downside, GDP comes back negative. We're in a confirmed recession. We could find ourselves below this quicker than we broke out of it. So Number two, trend lines are made to be broken, but they are not the end all be all. This was just an interesting add-on to the collective Bitcoin videos that I do update on my channel every single day. So I hope you did enjoy this video. While we are on the discussion of this parabolic trend line to the downside, I would also like to show you that on the 4-hourly time frame, we did try and flip this. We came back on the 4-hour, back tested it. You know, we were kind of sitting here for about 12 hours, and quite recently we've got rejected from it. So we're moving to the downside of this. While in the short term, this is a bearish signal, I'd also like you to take this with a grain of salt, because just like I said, this is simply a trend line. This is our best understanding of the price. It is really no more than a line in the sand that we're trying to use to quantify when sellers and supply is going to come in the market, and subsequently an excess of supply is going to decrease the price. That is simply all we're looking at for here. So definitely be cautious. I would not be aping in, FOMOing in if we do break above this. At some point in time, we will be breaking above this, but I will need to see extra bullish signals before I can become bullish on the markets. So that's all I've got for you today, my friends. It seems like, looking at our data points, the lines of attack are getting exponentially more brutal to the downside. I really only think Bitcoin has one final capitulation left in it before the bear market low is in. Once again, it's been your boy, Cowboy Trades, and as always, peace.